Hey everyone, and welcome to Unit 4. This is going to be the last unit from this class, and we're going to talk about monetary policy, specifically within the United States, so talking all about the Federal Reserve System. And in this video, we're going to be talking about the structure of the Federal Reserve System. We're going to talk about the creation and the foundations of central banking in the United States. Then we're going to talk about the groups and duties within the Federal Reserve, the powers that they have, and then close on a visit of the Dodd-Frank Act to talk about some more specific provisions that it has for the Federal Reserve System. And the Federal Reserve is one of the most complicated central banks in the world. And to understand why it's created the way that it is, we need to go back into the United States' history and look at the foundations of central banking and some of the concerns that Congress had in its creation. And so the very first attempt at its central bank in the United States was organized by the very first Treasury Secretary, Alexander Hamilton, uh, and it was meant to be a public private partnership with the only objective being to stabilize the financial system and oversee local banks. So those sound extremely like a central bank. And you have to remember that at this time, we had no such thing as a national bank or national banking system. And so this was really the only connection between local banks and the federal government. But there was stiff disagreement with Alexander Hamilton on the subject. A lot of Congress believed that the government had no business in the banking system and wanted to do as much as possible to limit federal government authority. And so the Bank of the United States only received a 20-year charter, but by that time, the time that it was renewed, the disapproval for the Bank of the United States and the concept of having a central bank just eliminated it, and so the charter was not renewed. However, quickly after that, there was another attempt to establish a public private partnership bank called the Second Bank of the United States, and it received its charter in 1816. And it did have a quite similar role to the Bank of the United States, which meant that it also experienced a similar fate. Congress did actually renew its charter in 1836, but President Andrew Jackson vetoed it, and there was not enough support to override the veto. And so the Second Bank of the United States ended in 1836. And after that, the rest of the 19th century, the United States did not have any sort of quasi central bank. However, in 1907, we had a significant financial crisis, and in response to that, Congress passed the National Monetary Commission in 1908, and that was only designed to study the creation of a formal central bank. And this was the very first time that a formal central bank, not a quasi public private partnership, had really gained any sort of momentum in the United States. And 5 years after that, the Federal Reserve Act established the Federal Reserve System in 1913. But as I mentioned, up until this recession, there was very little approval of a central banking system. And so there was a lot of fear about the power that a central bank could have. And so Congress did all it could to diversify power within the Federal Reserve System because of how uh, fearful it was of a single unified central bank based in DC. And so there are three separations of power within the Federal Reserve System. You have the power among bankers and business interests, among states and regions, and between the government and the private sector. And the desire was by Congress to separate control in the Fed to lead groups within the system with separate duties. And so they made four different groups: the Federal Reserve Banks, private commercial member banks, of which all nationally chartered banks are required to join, the Board of Governors, and the Federal Open Market Committee. And the Federal Reserve System was originally created to do the three following objectives: to control the amount of currency that was outstanding in the US economy, to control for the volume of loans to member banks, and implicitly to use the lender of last resort function. However, the modern Fed, as the financial system developed, gained substantially more power. But let's look at the groups and duties that the Federal Reserve Banks have. First, the Federal Reserve Bank system is comprised of 12 different banks that together make up the Federal Reserve System, and they were originally chartered to primarily conduct discount lending activities. And so they used to be the ones to provide liquidity to member banks, and in doing so, provides a decentralized way to fulfill the lender of last resort responsibilities. So if you look at the map below, you can see the map of the Federal Reserve Bank system, and where the branches are have never changed. So like right now, here in Lafayette, we're under the jurisdiction of the Chicago Bank. However, where I'm from in Wyoming, we're under Kansas City, family in California, and they're under San Francisco. And the banks were intentionally designed to have a broad geographic area with a variety of economies. And this was intentional to try and prevent any one interest group or state from obtaining preferential treatment from the district Federal Reserve Bank. So if you think about if only if there was a central bank that only looked after agricultural regions. So, you had a single bank that was through the Midwest, excluding, Chicago, which is a financial hub. It would probably be leaned towards protecting agricultural interests. And so the idea is that by diversifying the economies that comprise of a single district, there's no way that one uh, economy sector, whatever, can obtain treatment that is specialized from that bank. Now, as I mentioned, the where the districts are drawn have never been redrawn, but there is a growing cry for them to be redrawn to try and preserve this preferential treatment idea. And so, for example, in 1913, San Francisco district had about 6% of America's economy, so give or take roughly 1/12. But now it has over 20%. It has nearly a quarter of America's population. So there is some differentiation between the districts that was obviously not intended in 1913. Now, uh, you need to remember here and through the rest of the videos that the entire design is to try and prevent an interest group or member to just take over control of the Fed or to get any sort of preferential treatment, which means that the board of directors of the Federal Reserve Banks are carefully composed. So there are three classes. Class A have three bankers. Class B has three leaders in industry, commerce, and agriculture. And Class C has three public interest directors. So, for example, with Class A, you may have a vice president at Morgan Stanley or something like that. In Class B, you could have, the CEO of United Airlines, something like that. Or in Class C, you could have a humanitarian that leads some sort of charitable organization. And they have the following duties. First, to manage check clearing in the payment system, but that is quickly going away. It used to be that any check that you write gets cleared by the Federal Reserve banks if it is to a member branch, but as checks go away, this duty is going away. They also manage the currency in circulation by issuing Fed notes and withdrawing damaged notes from circulation. They conduct discount lending and administering discount loans to banks within the district. They also provide supervisory and regulatory functions, such as examining state member banks and evaluating merger applications. And the way they do is wherever the headquarters of a company are, that is what Federal Reserve Bank branch oversees it. They also provide services like collecting and making available data on district business activities and publishing articles on monetary and banking topics. So you probably have seen a lot of snips that I've taken from the from Fred, the which is supervised by the St. Louis Fed. They also have their president serve on the Federal Open Market Committee, which we're going to talk about in a couple slides. Also, uh, we can look at member banks. So these are commercial banks that exist within the United States. And remember, all national banks are required to join the Federal Reserve System, but for all non-national banks, it is optional. So right now we have about 20% of state banks and 38% of all commercial banks in the United States belonging to the Federal Reserve System. But even though that sounds like a small number, this comprises of nearly all bank deposits. It's almost exclusively pretty small regional banks that are not part of the Federal Reserve System right now. And it's also increasing. Banks initially didn't want to join the Federal Reserve System to avoid reserve requirements because if you remember, the Federal Reserve System requires banks to hold on to a certain amount of deposits. And these local banks did not want to join so that they didn't have to have this reserve requirement imposed on them and that they can lend freely. And so in 1980, Congress passed the Depository Institutions Deregulation and Monetary Control Act, which forced non-member banks to follow Fed set reserve requirements. And so the idea is that it doesn't give these small banks a competitive advantage by offering lower interest rates than these higher banks, as well as also letting them get more leverage since they don't have to keep reserves. And so at that point, the idea of avoiding reserve requirements became, kind of moot. It also gave members and non-members equivalent access to discount loans and to payment system services that the Fed provides. So back then, one of those big payment system services was clearing checks. So even non-member banks still have their checks cleared by the Federal Reserve now. And so, in doing so, it brought together a lot of the differences between being a member and a non member. So, it doesn't make much sense to not be a member today. Additionally, in October of 2008, the Fed started paying banks interest on their reserve requirements to lower the opportunity cost of holding reserves. So, on top of it, now they pay interest on the reserves, so there's even less of a reason to not want to follow Federal Reserve requirements on reserves. However, once again, noting that as of right now, the reserve requirement has gone away, so a lot of this discussion about reserve requirements is kind of moot at the moment. Now, moving on to our third group, the Board of Governors. The Board of Governors are generally considered the governing board of the Federal Reserve System. There are 7 members on it, and they are all appointed by the president for one single 14-year term. And the terms are staggered so that every other January, a new governor is up for a new appointment. And so the idea with that is that no president can sway too heavily the Board of Governors to shape it in the way that they believe that monetary policy should be conducted. Now, there are exceptions. For example, Alan Greenspan served as a governor from 1987 to 2006, and the reason why he was able to do so was because he was first filling in for a retired governor, and then he was appointed specifically to his own firm. Now, an interesting fact is that there is really actually no specific formula or resume requirements for a person to be selected for the Board of Governors. So, for example, the current chairman, Jay Powell, he actually has a law degree from Georgetown and was an investment banker. So he doesn't come from a super technical economic background. And then before Jay Powell was Janet Yellen, and she was pretty much the exact opposite. She's widely considered to be one of the best macro theorists in the world. She had a PhD in economics from Yale and then taught at Harvard, specializing in macroeconomic policy before going to uh, government. And then, as you may know now, she is actually the Secretary of the Treasury. Now, the Board of Governors, what they do is administer monetary policy. They conduct open market operations, they set reserve requirements, they conduct discount lending, they set the discount rate, and they set margin requirements. They also determine permissible activities for bank holding companies. The Board of Governors also holds 7 of 12 seats on the Federal Open Market Committee, so it does have by far arguably the most concentrated influence on setting guidelines for open market operations. And we're going to get now to the Federal Open Market Committee. And the FOMC is a 12-member Federal Reserve Committee that directs specifically just open market operations. And so it includes all 7 board of governors, and the chair of the Board of Governors also chairs the FOMC. So the Board of Governors have quite a bit of sway if they can come to an agreement on what open market policy should be. There's no power to overturn the Board of Governors. Then the president of the Federal Reserve Bank of New York is a permanent member of the FOMC, and then 4 of the other 11 presidents of regional branches of the Federal Reserve alternate time sitting on the FOMC, and they rotate every single year who is on the committee. Now, the FOMC is usually the main policy making body within the Fed. There are a couple exceptions, most notably the 2007 financial crisis, when the Board of Governors kind of seized a little bit of control, but then it did shift back to the Open Market Committee. And then the way that they actually implement their policy is through the open market desk. And they primarily do so by executing open market operations with what we call primary dealers. And these primary dealers are designated preemptively. So these are like Goldman Sachs. And then the Federal Open Market Committee, you're going to hear a lot about data for the Federal Open Market Committee in the context of books, and there's 3 books that contain data that dictate FOMC meetings. There's the Green Book, which has a national economic forecast for the next 2 years. The Blue Book, which projects monetary aggregates and other information to provide context for alternative monetary policies. And then the Beige Book, which has summaries of economic conditions in each of the 12 districts. And so collectively, the Federal Open Market Committee ideally reads through these books before even every meeting and then discuss the implications of what they contain. And so this is really where a lot of their analysts and such get to present their research and their work. Now, in case you haven't noticed, that is a lot to handle. There are a ton of checks and balances within this design, and the structure is always up for conversation. Policymakers and economists were actually really upset about the decentralized structure in the Great Depression. It was widely considered that the inaction of the Federal Reserve, especially at the beginning of the Great Depression, while the bank runs were happening, is part of the reason why the Great Depression was so bad. And so, in the original charter for the Federal Reserve Act, there actually wasn't the modern FOMC structure, and that was actually set in 1935. And the idea behind that was to actually give more control to the Board of Governors so that we could get a little bit more decisive action in the Fed to respond to pandemics, or not pandemics, recessions. Additionally, while the chair's vote is equal to all others in the Board of Governors and the FOMC, they do get to influence their policy indirectly. Usually, we end up seeing the chair's agenda dominating FOMC and Board of Governor meetings because they're the ones that set it. So it's more of a implicit influence rather than explicit influence, but we usually see open market actions that closely resemble what the chair wants to see. And so here we have a nice, concise summary of everything that we've talked about. So you have your chair of the Board of Governors that directs the monetary policy, who sits on the Board of Governors, supervises the board staff, and then votes on and sets the agenda for the FOMC. Then the Board of Governors, they get to set discount rates and reserve requirements, as well as their voting members on the FOMC, which is, if you remember, the director of open market operations. And then there is a little bit of two-way discussion because the FOMC, including the Reserve Bank branches, they do get to do a lot of consultation towards the Board of Governors. So there is a lot of moving parts within this, but a very clear, concise way of clearly seeing where the delegation and separation of powers exist. And now, finally, we're going to talk a little bit more about the modern construction of the Fed, specifically through the Dodd-Frank Act. And the Dodd-Frank Act, if you remember from last chapter, was introduced uh, to try and rein in some of the critiques that Congress had on the dealings and proceedings of the 2007 financial crisis. And it introduced several new positions in the Fed. So first, it increased regulatory responsibilities through a mandatory membership of the new Financial Stability Oversight Council. It also restricted the Fed's role as lender of last resort. It created the vice chair for supervision role, which is always going to be one of the board of governors and not the chair. And so their idea is supposed to be charged with leading supervision within the Fed. They also started annual audits from the Government Accountability Office, and these audits are reported to Congress so Congress can get a little bit of a better idea of what's going on at the Fed. They also changed Class A directors, so if you remember, those are banking representatives, so that they cannot participate in bank president elections. So this is to try and limit the power that the banking system has on the Federal Reserve's proceedings. Additionally, they made public all Fed open market operations, including even the names of these institutions. So, if you were interested, you could go up anytime and see what the Federal Reserve is doing in the open market. They also created the Consumer Financial Protection Bureau, which exists within the Federal Reserve. It's in the same building, but it actually does not allow the Fed direct oversight. So even though the Fed gives the budget to the CFPB, it has no oversight or directives from the Fed. It exists completely autonomous.